Okay, we will finish up part 2 of Lecture 8, going over the introduction to corporations this week. Um, we left off at the professional service corporations. They are regulated by Florida Statute 621, and Chapter 621 is it's a large statute, but it has all the characteristics laid out of the personal service corporations. And I just, to try to simplify a little bit, a professional service corporation is just like an S corp. Usually they're small, so they're just like an S corp, except they have professionals that are the shareholders. All the shareholders have to be of the same profession, and the profession has to be regulated by the state of Florida. So lawyers, we are regulated by the Florida Bar. Lawyers can form professional service corporations, but that means that no paralegal can be a shareholder in that corporation. No doctor can be a shareholder in that corporation. They all have to be in the same profession. However, doctors, as long as they are all in the same profession, then they can form professional service corporations. Dentists, accountants, any profession that is regulated by the state of Florida, members of those professions can get together and they can all be shareholders of a corporation, which is called a professional service corporation. And you have to have PA, which is professional association. It has to be in the title of your corporation. So let's just quickly look through the characteristics of the professional service corporation that I've got in your notes. The purpose must be to practice, and this has to be in your articles of incorporation. The purpose must be to practice in a profession which requires licensure and state regulations, for examples, physicians, lawyers, dentists, architects, etc. They may not engage in any other business, so it can only be one business, one profession. You can't have dentists and attorneys working together. Every shareholder has to be a member of the same profession. Shareholders must be a member of the profession, and they may not merge with a corporation except another Florida professional service corporation, which is registered to perform the same type service. So you can't have architects getting together with orthodontists and merging their two professional service corporations. The requirements for a professional service corporation is that you must put the purpose in the articles of incorporation. It can only have the corporation can only have one purpose, and that has to be to do that type of work that profession does. The name must contain the words professional association or PA, or it can say chartered. Usually professional service corporations are S corporations, so Florida corporate law governs, and because they are usually small, they don't have more than 100. I often wonder if Jewett, the big orthopedic clinic in town, I often wonder if they are a professional service corporation. And Florida corporate law governs, so it requires that only one licensed person can be a shareholder. Only licensed persons can be a shareholder. All right. Another type or another classification of corporations that we have here in the state of Florida are nonprofit corporations or not-for-profit corporations. These are generally formed, and I'm going to read from my notes because this is IRS speak. You have to be one of these. You have formed for charitable, civic, benevolent, historical, patriotic, civic, cultural, athletic, or religious purposes. They must incorporate like any other corporation, but they must apply for a federal tax exemption according to the Internal Revenue Code 501c. So anytime you hear of a 501c, you know that you're dealing with a nonprofit organization, and they don't pay taxes. They are governed by Chapter 617 of the Florida statutes, and in Florida, they have to utilize the words not-for-profit in their title or nonprofit. Stock is not issued in not-for-profit or nonprofit corporations. And don't be fooled. Nonprofit corporations, it doesn't mean that they're not profitable. If you go on Sunbiz and you kind of scratch around, you can find that some of the officers make quite a good living running these not-for-profits. All right. The fifth classification is a public corporation. A public corporation is one that's publicly held or publicly traded. These are just corporations that you see on the New York Stock Exchange or the NASDAQ or the S&P 500. They are companies who sell their stock to the public. So public individuals can purchase stock and then hang on to it as long as they want to. And when they feel like it's made a lot of money or they want to get out, they can just simply cash out and take their winnings after paying taxes on it, of course. Sometimes when people buy publicly held stocks, the stocks go down in value. And so people will want to hang on to them until they come back up in value so they don't lose money. So it's just a way of indicating whether the stock is publicly traded and can be purchased by you and me and people outside of the business, as opposed to number 6, privately held corporations. These are just corporations whose ownership of shares, they still have shares, but they are limited to a few people. You can only purchase this type of share if you are within that private group of people who's allowed to. Publix is a privately held corporation. Sometimes employees are given shares of stock. Sometimes, the majority of the stock is held by, I think, the original owner's family, and then the rest of the stock is held by employees. Some advantages. We will go through these because I think you're kind of getting the idea with corporations, but let's just make sure that you understand the reason that corporations came about was to have limited exposure to personal liability. However, there are other options now, so they're not as popular. Corporations are not as popular now as, say, the limited liability company. But generally, these came around, and the biggest advantage was because they had the protection of protecting their personal exposure. There are some limitations, however, on this limited liability. The first one being piercing the corporate veil. If the corporate veil gets pierced, then all bets are off. So it's very important to have good paralegals who know what they're doing to make sure that all the I's are dotted, all the T's are crossed. And shareholders in new or smaller corporations sometimes are required to give personal guarantees on a condition of a loan. So if you are not from a corporation that's been around a long time, if you're just starting one up, the bank might say, we'll give you this loan, but we want a personal guarantee, because they know corporations that the creditors can't come after the shareholders. So sometimes when in the beginning, the shareholders will say, okay, we'll personally guarantee it. And then once we pay off the loan, then the next time they see you more as a legitimate corporation. All right, tax benefits. Sometimes I want to omit this one because right now there are there is a tax advantage. When I began teaching this course, President Obama was in power, and the tax rate was 39.7 or 39.6%. It was about 40% that corporations had to pay in taxes. And so they were just like flooding out the doors. They were all, and as a matter of fact, realizing that all the American companies were leaving America. Ireland, of all places, Ireland came up with an 11% tax rate for corporations, and many of our American companies went there. So when President Trump got into power, he tried to woo them all back with a 21% tax rate, which is still more than Ireland and many other countries, but it was much less than the 40% that they were used to paying if they stayed in the United States. However, they did get many fewer deductions that they were able to take. So this is tax benefits. There can be a tax benefit, and sometimes just depending on the presidency or who the decision makers are at the time in the United States, sometimes it's not an advantage. Sometimes it's a disadvantage. All right, another advantage is the business continuity, because corporations exist perpetually, and if I own stock in Disney and I die, Disney's going to be fine. They go right along. The corporation is not dependent on the living or even the incapacity of the shareholders. Enhanced ability to raise capital. Think about this. Now remember, with the partnership, and even especially with our sole proprietor, if they needed money, they had to dig into their own pockets. Basically, working hard was the only way to make more money, or try to add another partner unanimously. But a corporation can simply, in order to raise money, they just sell more shares. You don't have to get the agreement of everyone else, and you don't have to take out a loan. You can just sell shares and obtain money through that way rather than the traditional means. Okay, centralized management. If you like centralized management, then this is a great advantage of a corporation, because you have all of your shareholders, so you have all of this money that can be funneled to the folks that are kind of overlooking and driving the mission of the corporation, which would be the board of directors. And then the board of directors, they elect the officers who have to directly report to those boards of directors to make sure that they have to report to that board to make sure everything that they are doing is within the mission statement. So it's a very straightforward, easy to understand type of structure. The ease of transferability of ownership. If, like I said, I own shares of Disney and I die, Disney's going to be fine. They go right along, and my heirs will inherit my shares. So really, there's not even a hiccup. Separate record keeping. A corporation has its own records and accounts. That's a have to, but it can also be, because they have to do that, if there are any questions that are raised, then all those records are all set up, and it's quite an advantage to have everything there clear, especially for us who work in the legal profession. The corporate books, the separate record keeping is a have to. All right, ease of estate planning. Shares are easier to devise than a partnership interest. If I were going to die, if I did die, I couldn't leave my partnership interest to my children, but I can leave my shares if I own any shares of any stocks. A separate credit rating. I think we kind of mentioned this before, that a corporation can go bankrupt without harming the owner's credit, without harming the shareholder's credit at all. And the shareholder can go bankrupt without harming the corporation's credit. So they're completely separate and they have nothing to do with each other. There are many deductions available to a corporation, a C corporation, not the S corporation, remember, but the C corporation. Maybe not as many as there used to be, but they still can deduct rent, salaries, interest, utilities, travel, entertainment, insurance, legal and accounting costs, supplies, benefit plans, 401k plans, any of their matches that they do, they can deduct all of that. So there's quite a few advantages to being a corporation. Now, as far as disadvantages, corporate formalities and reporting requirements, those are the biggest disadvantages. There is so much to wade through. It is the most structured entity around. It's got more requirements than any other entity that we've looked at or will look at. It must be properly formed to comply with the law, which is time-consuming and expensive. And it's more expensive to create than the LLC, but cheaper filing fees. It must qualify to do business in other states. When a corporation wants to go to another state, one of the disadvantages is that it's going to have to stop your if you want to do business in another state, you're going to have to stop and qualify, find out what their requirements are, satisfy their requirements, and then go forward. There is very formal management. There are required meetings. You must hold meetings, and there are strict formalities within those meetings, and this is all set forth in the law. So, huge disadvantage in that there's all these boxes to check and things to ensure happen. Number 4, you must file a separate tax return for C corporations. Remember, the S corporation just files an informational return, but the C corporation has to file a separate tax return. It's many more forms. All right, number 5, double taxation. Except for S corporations, the profits are taxed and then the dividends are taxed. There are indeed ways to avoid double taxation. You can form an S corporation or you can form an LLC. Businesses can give bonuses or salary increases, which are later deductible. The tax is still owed by the individual, however, in the corporation. Then there are a couple of, there's something called a Section 1244, where corporations can get favorable tax treatment if they sell stock at a loss. The ordinary loss offsets the ordinary income. That's something that accountants will watch for, and it's not something that people try to go out and do generally. But 1244 does help corporations out. And then there's qualified small business stocks. That's a Section 1202. If you hold small business stock for 5 years or more and then you go to sell it, you only pay half of the capital gains tax normally required. This is only for C corporations, and the assets have to be less than $50 million, and at least 80% of the assets must be from trade or business. So this is something that is large corporations will use. All right. Another disadvantage is that states charge or collect corporate taxation. So state taxation is something, except for our trusty dusty S Corp, which do not. And so there are some disadvantages, but generally the advantages will outweigh the disadvantages when clients are thinking about forming a corporation, unless they decide to look at maybe a limited liability company. All right. And the last thing I urge you to do is take a look at the role of the paralegal in your book, in your textbook, because next to litigation, corporate paralegals are the highest, the highest percentage of paralegals are corporate paralegals. They tend to work with a great deal of autonomy. They get to know their jobs very well, and attorneys rely on them. They can go days without seeing an attorney and just getting everything in order, and then the whole corporate book or something goes to the attorney for review. So if you like to have big projects and work on them by yourself, and then have the attorney come and look at it all in one bang, and then you don't defend it, but you explain to the attorney if they have any questions what's going on. And yeah, it's a fun practice. But it's completely different from the world of litigation, which is what I come from. So that is all I have for you on the introduction of corporations. And the next time I see you, we will be talking about corporate formation and how to form corporations. So until then, be safe, and I will see you guys soon.